What if the biggest move in gold and silver is not happening on price charts, but behind closed doors? What if the real story is not volatility, but quiet shortages forming while most people are distracted by headlines? Stay with me, because by the end of this video, you will understand why the next phase of this market will reward patience and punish emotion. Welcome to US Market Pulse, where we cut through noise, ignore hype, and focus on facts that actually matter for your wealth decisions. This channel is built on macro logic, verified data, and disciplined thinking, not rumors or viral fear. Today we are examining a growing claim that is spreading across financial media and social platforms. The claim is simple but powerful. Global gold and silver markets are entering a structural supply shock driven by export restrictions, geopolitical tension, and rising industrial demand, while paper markets continue to mask the real stress underneath. If this claim is true, the consequences are not small. Physical metal becomes harder to source, premiums rise, volatility increases. Long-term holders benefit, while short-term paper traders face whiplash. The gap between real metal and paper promises widens, and price discovery becomes unstable. Let's ground this discussion in credibility, not emotion. Over the past year, physical silver premiums have remained elevated even during price pullbacks. COMEX inventories have shown repeated drawdowns. Options volume in precious metals has surged, signaling institutional positioning rather than retail speculation. On the gold side, central banks continue net buying led by emerging markets reducing dollar exposure. These are not opinions. These are observable behaviors. Now let's explain this simply. Paper markets trade contracts. These contracts can be settled in cash. Physical markets deal with real metal that must be mined, refined, transported, and delivered. When supply chains tighten, paper prices can stay calm for a while, but physical availability does not lie. When industrial users need silver for solar panels, electric vehicles, and data centers, they cannot substitute it with promises. Analysts are divided on what this means next. One skeptical camp argues that recent supply shock narratives are exaggerated. They point to recycled supply, substitution, and slowing global growth as reasons prices could stall. They warn that social media amplifies fear faster than facts, and that many claims collapse under scrutiny. The bullish camp sees something very different. They argue that silver is facing a multi-year deficit driven by energy transition demand and constrained mining investment. They highlight that new silver mines take years to bring online, and that by the time supply responds, prices have already repriced higher. In their view, gold benefits as monetary insurance while silver benefits as both money and metal. The neutral, macro-focused analysts sit in between. They acknowledge supply tightness but emphasize that price direction will depend on real interest rates, dollar strength, and geopolitical escalation. They view gold as stability and silver as leverage, both valuable but for different reasons. Here is my balanced take at US Market Pulse. Ignore viral leaks and dramatic predictions. Focus on fundamentals you can verify. The fundamentals show tight physical markets, rising industrial demand, and increasing geopolitical risk. They do not guarantee straight-line price increases, but they do support higher long-term flows. This is where psychology becomes dangerous. Retail investors often buy when fear peaks and sell when volatility spikes. They chase headlines instead of understanding structure. Paper markets encourage this behavior because price moves feel fast and emotional. Physical markets reward patience but test conviction. The most common trap is selling into volatility and planning to buy back lower. That works until it doesn't. When shortages appear suddenly, the market gaps higher, and re-entry becomes emotionally and financially difficult. Let's talk realistic upside scenarios. In a base case where global growth slows modestly but supply remains tight, gold holds value and trends higher gradually, while silver revisits and stabilizes above prior cycle highs within the next 12 to 18 months. In a bullish case where industrial demand accelerates and export restrictions persist, silver moves into triple digits over the next 2 to 3 years, while gold benefits from capital rotation out of fiat risk. In an extreme case, driven by severe geopolitical escalation or currency stress, prices overshoot, but volatility becomes violent and unforgiving. Now, risk matters. Bullish theses can be invalidated. If real interest rates rise sharply and stay elevated, metals face pressure. If governments release strategic reserves aggressively, prices can retrace. If global conflicts de-escalate and supply chains normalize faster than expected, scarcity premiums fade. Ignoring these signals is not conviction. It is denial. So what is the strategy? Discipline over drama. Size positions, so volatility does not force bad decisions. Accumulate gradually rather than chasing spikes. Understand the difference between trading paper and owning physical. Think in years, not weeks. Treat metals like insurance and opportunity, not lottery tickets. The final conviction is simple. Fundamentals drive long-term outcomes. Rumors create noise. Scarcity, demand, and macro stress create value. Those who respect structure and manage risk tend to stay in the game long enough to benefit. Thanks for watching US Market Pulse. This content is for educational purposes only and not financial advice. Risk management always comes first. If this helped you think more clearly about gold and silver, like the video, subscribe and turn on notifications for more unbiased US market and macro insights.